ahead, Wall Street Willie. What is a fund? A fund is a pool of money that is collected from many investors for a specific type of investment, like buying stocks, bonds, real estate, or a combination of different asset classes. The investors don't own the assets directly, but get a part of the fund, called units, in proportion to their contribution. As the value of the investments made by the fund goes up or down, so does the value of each of the fund units. What are the types of funds? The main types of funds are mutual funds, index funds, exchange-traded funds or ETFs, and hedge funds. Mutual funds are usually managed actively by a portfolio manager who tries to beat the market. Index funds are passively managed funds that track a certain index and buy and sell stocks based on the changes in that stock index. Exchange-traded funds, as the name suggests, trade on a stock exchange and are usually passively managed. Hedge funds are high-risk, high-reward funds actively managed by hedge fund managers and require a lot of money to invest in. What does a fund invest in? A fund invests based on its stated purpose. A fund's purpose could be to invest in specific asset classes. For example, equity funds invest in stocks, fixed income funds invest in corporate or government bonds, and balanced funds invest in both stocks and bonds. A fund could also offer its investors a specific type of return. For example, growth funds focus on capital appreciation over time and invest in stocks that have a high potential of growth. On the other hand, value funds invest in undervalued stocks that pay high dividends, offering investors a steady stream of income. Funds could also be sector-specific, like tech funds that only invest in technology companies, or healthcare funds that only invest in companies in the healthcare industry. Why would I want to invest in a fund? One of the main benefits of using a fund to invest instead of investing in individual securities is diversification. Let's say you want to invest in large-cap companies. If you invested on your own, you might be able to invest in just a handful of companies, but that would not be a diversified portfolio. If instead you use an index fund that tracks the S&P 500, you would get a slice of the top 500 large-cap companies. This way, your portfolio would be well diversified. Another huge benefit is that you only need a small amount of money to get started, as many funds don't have a minimum investment requirement. For example, if you invested in a fund that tracks the Nasdaq Composite, you could get access to thousands of technology stocks for less than $100. But if you wanted to buy even one share of a tech company like Amazon, you would need a few $1,000s. Another benefit of investing in funds is that you don't need any expertise in analyzing stocks. The fund managers are the experts who do that for you. Thank you very much, Wall Street Willie. You're welcome, Super Cooper. Remember, finance is your friend. If you enjoyed this video, check out related videos and playlists in the description box below.